Millions of private sector employees park their money with the Employees Provident Fund Organisation or EPFO to ensure a hassle-free retirement. But do you know where EPFO invests this money to give you those good returns? And do they invest in equities too? The government recently told the parliament that the retirement fund body has invested rupees 1.59 trillion in exchange traded funds or ETFs as of March 2022. And the investments are now worth rupees 2.26 trillion. This means EPFO has in notion made rupees 67,000 crore from its ETF investments. ETFs are funds that track the yield of indices such as Nifty or the Sensex. But unlike mutual funds, the units of ETFs are listed on the stock exchange. EPFO's total corpus is anywhere between rupees 16 trillion to rupees 17 trillion according to the latest available data. And it has traditionally been a big investor in debt securities. Currently, the retirement fund body invests 85% of incremental deposits in debt instruments, mostly AA or above securities. EPFO's debt investments are worth about rupees 14.46 trillion. Starting 2015, the government allowed it to invest 5% of the investable deposits in equities. Currently, the fund body invests up to 15% of its investable deposits in ETFs. It is also allowed to directly invest in listed shares of companies with a market cap of over rupees 5,000 crore. However, it invests only in ETFs and not in individual stocks. The investment in ETFs is made based on Nifty 50, Sensex, Central Public Sector Enterprises and Bharat 22 indices. The body had invested rupees 43,568 crore in FY22, rupees 32,000 crore in FY21 and some rupees 31,500 crore in FY20 in ETFs. The objective of EPFO investments in equities was to provide good returns to its subscribers in the long term. An analysis shows that equity markets have given higher returns than the debt markets. In the last 5 years, the average return on investments in Sensex and Nifty was 18%, while the government debt and highest rated corporate yields stood at 6.8% as of March end. On the other hand, the return on EPFO's debt investments was 6.78% in FY21 and 7.5% in FY20. It was 8.5% in FY19. The fund body's notional equity returns on EPFO equity-related investments increased from 14.6% in FY21 to 16% in FY22 according to the government. Some experts say EPFO's allocation to equities has been on the conservative side according to a Thinking Ahead Institute and Pensions and Investments annual joint study. The top 20 global funds on an average invested 41.7% of their assets in equities, while North American, European and other regional funds have invested a majority share in equities. Asia Pacific funds have largely allocated assets to fixed income investments. So, do restrictions around equity investments cut down the potential of higher and more sustainable savings model for the body?
So I think it's a nice breakup. 15% is also not something which will break your portfolio if something goes wrong. So nice choice in my opinion. And this is really long-term money. So I think it's a good choice. But as I said, there are many challenges to this. If I were, let's say, so I probably be more okay with something like a 25% exposure. But then I would also say that for the equity exposure, instead of guaranteeing them returns, you give them units just like in case of mutual funds. So let the investors carry the risk of the equity investments. Government should not carry it. EPFO should not carry it. Why does EPFO? So EPFO will guarantee returns, whatever the return is, 8%, 9%, on the non-equity portion of the EPF allocation. On the equity allocation, we allot them units. Let them and then we shall see how that goes. So the risk must lie with the investor. If that is the case, I think I see no harm in increasing this to 25%. But yes, in the current form, if you keep increasing this because of all kinds of lobby pressures, I don't think that's the right way.
The safe investment bets mostly in fixed income instruments are also mainly due to the largely unpredictable nature of the market and the fact that EPFO has to offer fixed interest returns year after year to its over 60 million subscribers, irrespective of its underlying portfolio returns. There have been some news reports that the allocation to equities might rise to over 20%, but the government so far denied such a proposal.
I also feel that the true benefit of equity allocation having added to the overall asset allocation, is not really being enjoyed by the members because of the way the accounting is being done. Yeah, I think if you look at the way to add equities in the retirement fund investment allocation, is to bring in member choice, right? Which essentially means that the PF scheme needs to be amended. It's going to be a difficult task, but the way forward is that this whole thing of guaranteed interest rate will have to be slowly done away with, because equities and guarantee is a recipe for actually disaster. Imagine you go to a mutual fund and ask him to give a, say, 8.1% interest rate guarantee on their balance fund. They would shy away, they would not do that. The regulator, SEBI, would not allow that, right? So it's, from a go forward basis, I would think that if equities were to deliver significant return to members, it has to be done through employee choice or member choice, which requires scheme level reform.
There are mixed views on whether EPFO's equity investments are conservative. However, in the long run, EPFO may need to go beyond ETFs that track two major domestic indices and make more diversified equity investments. The pension fund may also look at global diversification of the overall portfolio.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.